Well, welcome to this special IEA media briefing on Are We in a Financial Crisis? I'm Matthew Lesh, the Director of Public Policy and Communications here at the IEA, but you're very much not here to listen to me. As we all know, that the collapse of Silicon Valley Bank, the situation with Credit Suisse's merger, the questions about First Republic at the moment have all raised fundamental questions about the state of our financial sector, whether or not we have the right regulatory mix, as well as what could potentially come next for our economy. We've assembled a star IEA panel who are going to tackle a few different elements of this discussion. I'll start and throw it straight to Julian Jessop, who's an IEA economics fellow, and he's going to give us some background in terms of what is causing the current immediate crisis we're seeing in some of these banks.
Thank you, and good morning. I'm going to run through particularly what happened at Silicon Valley Bank and also at Credit Suisse. I think the common element in both of them was that this was basically a classic bank run where investors and customers lost confidence in the bank, withdrew their money, and that triggered a death spiral of outflows of assets and the need to basically to shut the banks down and start again from scratch. So if we look at the individual circumstances, take Silicon Valley Bank first. I think although it wasn't in any way unique, it was relatively unusual in the way that it was running its business. So Silicon Valley Bank, as the name suggested, was basically focused on a relatively concentrated customer base in the tech sector. A lot of these companies were cash-rich startups with lots of money to deposit somewhere, and many of them deposited in Silicon Valley Bank. That left the bank with what you might see as quite a nice problem, which is a lot of cash to invest, and they did what they thought at the time was quite sensible, and park a lot of that money in long-term government bonds backed by the US Treasury, which at face value is not a daft thing to do. But what then happened, of course, is that as interest rates rose, that presented two big challenges for the bank simultaneously. One is that higher interest rates hit the tech sector quite hard, and a lot of people wanted to get access to their cash quickly. At the same time, the value of the government bonds that Silicon Valley Bank owned, started to fall pretty sharply. So the bank was dealing both with a run on deposits and also a big fall in the value of the bonds that it owned, and that triggered the death spiral that dragged the bank down. Slightly different circumstances in Credit Suisse. Credit Suisse was obviously a large bank, well regulated, and in many ways looked pretty healthy. So it had healthy balance sheets and decent capital and liquidity ratios. But it had long been seen as pretty much the weakest link in European banking. It had been terribly run for many, many years. Pretty much any financial scandal you care to mention, Credit Suisse was involved in one way or another. And it had notorious problems with lax internal controls. And there are two things in particular early in the month that tipped it over the edge. One is that the US securities regulator insisted that delay the publication of its annual report and accounts because it wasn't happy with some of the numbers and some of the internal controls in it. So that was a terrible look. And on top of that, a few days later, the biggest single investor in the bank, the biggest shareholder, Saudi National Bank, said it wouldn't be buying any more equity in the bank. As it happens, this was largely because it already owned nearly 10% of the bank, which was its own limit. But again, that was seen as a lack of confidence. If cash-rich Saudis aren't willing to put more money into Credit Suisse, why should anybody else do so? So there are some excuses for the particular failures at these banks, but I think it is indicative of a wider problem. In both cases, the catalyst was the return of interest rates to more normal levels, but not actually particularly high levels. So in the UK, interest rates have only risen to 4%, which prior to the global financial crisis would have been considered a low interest rate. But a lot of parts of the financial system were dependent on interest rates remaining low and money remaining cheap. And I think that's going to be a problem for large parts of the rest of the economy as well. Indeed, what we've seen in Silicon Valley Bank and at Credit Suisse isn't even the first of these crises. That was arguably what happened in the UK pension fund industry late last autumn with the so-called liability-driven investment strategies. And also in the real economy, more recently, the weakness in the housing market as people have adjusted to the idea that mortgage rates are returning to what might be considered more normal levels as well. So I'm not necessarily overly worried about the banking crisis that we're already seeing rippling into a global financial crisis. But it's indicative of the problems that you see when you get the end of a long period of very low interest rates and cheap money. And the whole economy, not just the banking sector, will have to adjust to that.
Thank you very much, Julian, for that very useful introduction. I'll just add as well that each of our panelists will be speaking for around 5 minutes or so, and then we'll be taking questions from the audience. So if you do have any questions or thoughts or comments, please do put it in the Q&A or raise your hand as well. I'm happy to promote you to a panelist, and you can ask the question or I can read out the question. So next we're going to go to Jamie Whyte, who's an IEA Senior Research Fellow. He's a former consultant in the banking sector, and he's going to discuss a little bit more on how the government has responded to these crises and the potential risks and issues around the bailouts that we've seen. Sorry, Jamie, you just need to unmute your audio. We're classic back here to.
Good point. Good morning. I'd like to start by saying I agree with Julian that I'm not terribly worried about a major global banking crisis like we had in 2008. The reason is that the 2008 one was caused by exposure to the US housing market that had been spread around the banking system by collateralized debt obligations, mortgage-backed securities, that kind of thing, which everybody invested very heavily in and didn't really seem to understand the risk entailed in it. The systemic factor at the moment is interest rate rises, as Julian's talked about. But if you look at the cases, the Silicon Valley Bank and Credit Suisse, in the case of Credit Suisse, that didn't seem to play a major role. It looks more like what you'd call in the consulting industry, at least, we always used to distinguish between so-called business risk, market risk, and credit risk. And it looks like Credit Suisse's failures are really a kind of business risk, reputational risk management problems. Silicon Valley Bank really had quite shocking apparent incompetence, both by the bank and by the bank's regulator, in not managing its balance sheet risk, asset liability risk. The stress testing done by the Fed seems to have been farcical, looking at worst case scenarios or extremely adverse scenarios in which interest rates go up 1 percentage point or 2 percentage points. I mean, it's kind of beyond my understanding. So I think there's an idiosyncratic element to these failings that is more pronounced than in the last crisis. And after the last crisis, the regulators insisted that banks carry much more capital, more liquidity, and so they probably are in a more robust position than they were. But now I really want to make points about the whole way in which banking is regulated. One problem, it seems to me, is that there seems to be an assumption that the regulation of banking is there to stop banks from engaging in perverse behavior that they would engage in if they weren't regulated, if it was a purely free market in banking. And this gets things completely the wrong way around. The regulations are there to counteract perverse incentives created by, well, basically by deposit guarantees and reliable bailouts. The perverse incentive is that if the government lets it be known that creditors of banks face no risk because the government will always make them whole when the banks get in trouble, that removes, sorry, I'll fix this little problem. That removes the pricing mechanism on risk. So when banks become riskier, they don't have to pay more, or not as much more as they should, to borrow, to fund their operations. Now, it's worse than that. People talk about moral hazard, right? So it removes this price mechanism constraint from them, from their risk-taking. It's not just that it removes it, it actually requires them to take more risk. Think of it like this. I'm a bank, I want to raise funds, I want to attract deposits. How am I going to do that? Well, I used to do it in the old days, before all this banking regulation, I used to do it by being safe and advertising the fact that I was safe to depositors, because then they say, you're not going to put your money in an unsafe bank, right? Now, so they were competing for deposits by being safe. I mean, they're going to pay interest too, but they also want to be safe. Now, they don't have to compete. In fact, they can't compete by being safe. So how do they compete? Well, they can only compete on price. How do they make themselves able to pay higher rates of interest on deposits? Well, they have to take more risk in their other activities. They have to be more leveraged. They have to lend to riskier borrowers. They have to do all these kinds of things that make the bank less safe. So by the government making depositors safe, it forces banks to become less safe. Then it intervenes with regulation to say, oh, okay, since there's now no market constraint on your risk-taking, we'll impose a regulatory constraint on your risk-taking. That's the model that we operate under today. And I think it's clear from 2008 crisis that it doesn't quite work. If you look at what happened, people go, oh, the banking system was underregulated in 2008. Well, as a matter of fact, the Basel II Accord had just come into force in 2007. This was the most elaborate international regime of regulation, I think, ever known in any industry. All the banks that failed were compliant with it. In fact, every UK bank, and I think the American ones too, although America wasn't yet under Basel II, all the UK banks that failed had more than 50%, that their capital levels were more than 50% above the required minimum. So the reaction, of course, was more regulation, higher capital levels and so on. Well, again, the banks are getting in trouble, we're compliant. So there's something wrong here. Now, I've spoken for quite a while. I won't go on about why I think this whole approach can't ultimately work. I'm happy to come back to it in the questions. And I think maybe Andrew's going to make some positive suggestions for how things could be done a bit better. But I just want to flag what I think is the fundamental problem in the banking regime as it is today in the world.
So that the government effectively then is doubling down on this underlying issue by trying to address the short-term financial liquidity issues.
Yeah, as so often, it creates a problem and then tries to solve it. So it creates perverse incentives and then tries to control them with regulation. And ultimately, it's if depositors face no risk, if bank creditors face no risk, there's almost no good solution to this problem. And so the Fed's lifting the deposit insurance in the case of Silicon Valley Bank. So in theory, it only covers people up to $250,000, but they lifted that, and so they're covering all the depositors, all the creditors. Terrible mistake, in my view.
Andrew, do you want to come in there with some creative solutions or thoughts? Sorry, you're muted there, Andrew.
Indeed. So the post-2008 financial system, the regulatory framework that was established after that, improved things a bit, but it still left the system of regulation fundamentally flawed. Too much of the answer was based around the idea that you could solve things by having much larger capital and liquidity buffers. Too little of the answer was based on using market processes. There were some encouraging factors in there, but they've now been tested and shown to be wanting in ways that I'll explain, and I'll explain what I think would be a solution to that. One place to start with some of this is to note that around the time 2008, many people thought, well, the thing was that we had as Jamie was just saying, we had this very internationally coordinated financial crisis, which had come in just off the back of the most internationally coordinated financial regulation of all time, banking regulation via the Basel process. And people thought that the solution to that had to be to have more international coordination. But an issue here is that when you replace individual business and personal assessment of risk with regulatory assessment of risk, that is itself a source of systemic coordination of error. Because if the regulator gets it wrong, it gets it wrong for everybody. And if you internationally coordinate the processes, then if the international regulation gets it wrong, not only gets it wrong for everybody in one country, but it gets it wrong for everybody all over the world. International coordination is a source of systemic coordination of crises, which is perhaps fortunate in that at the moment the regulators are in quite significant row with each other about how to address the current banking issues. So we have at the moment the EU authorities are more or less incandescent with the US authorities for breaking some pledges over many years about not guaranteeing all deposits in the system. So essentially the US authorities responded to the current crisis, which is a pretty significant crisis in the US. What we have is the second and third largest bank failures of all time. In the US, only the Washington Mutual ranks ahead of either Silicon Valley and the Signature Bank failures. And they one of the features that they responded to that was by de facto saying, well, all the US depositors are safe, regardless of any undertakings we previously made about having what was already a very high, far too high deposit insurance limit of $250,000. The EU authorities had thought that one of the central points of the whole 2008 system was that you didn't guarantee deposits. Certainly you didn't guarantee uninsured depositors. So you tried to contain the process. And the EU authorities were right about that. Deposit insurance is a cancer at the heart of the whole capitalist system. It renders the whole thing ethically unviable. And indeed, deposit insurance, because banks in modern economies are the main allocators of capital, that spreads that fundamental injustice right out across the economic system. Deposit insurance, what it does is it makes capitalism into a system in which rich people, depositors, get high returns when things go well, and then when things go badly, they use their political power to make the state come in and bail them out. It's absolutely ethically indefensible. One problem with that, though, is, as I'll explain in a moment, politicians can't avoid doing it. And you need to have a solution that enables them. Mere political will isn't enough. So we see that in the US situation. Just having said for a decade or more, we won't get bailout depositors. When push comes to shove, you do, because they haven't addressed the fundamental flaw which makes them bail out depositors in the first place, which isn't a matter of just the regulatory framework and so on. In general, it's not a matter of not wanting to not bail out depositors. The problem is more fundamental than that. But just before I come on to that and how to address it, let's think of the other row. So the other row is based around another key feature of the post-2008 framework, and that's between the UK and EU authorities and the Swiss authorities with regard to the Credit Suisse case. Because another of the important features of the post-2008 framework was the introduction of contingent convertible debt. So this was a class of highly junior debt, which was to be bailed in, where that was converted into equity or zeroed in the case of Credit Suisse when a bank became distressed. I argued at the time that this concept was flawed, in that all bank debt should be fundamentally seen as bail-inable, and what should happen is that you should just bail it in. The authorities should simply, in the case of a resolution, the resolution process should bail in the debt according to its level of seniority. But if you are going to have this class of bail-inable debt, the only purpose of it would be if you bail it in under circumstances when you don't zero the equity as well, because otherwise there's no natural. So the concept that was written, that the Swiss appear to have applied and was actually probably implicit in a number of the debt contracts, was that the debt was bailed in at the point at which you had your other equity triggers and so on fell below a certain threshold. So it wasn't quite, it's a special category of debt that gets zeroed without the equity getting wiped out. Now, so on that, I think that the Swiss authorities were basically right about the treatment of these contingent convertible debt. That is the right way to do things, and the EU and the UK are wrong. But the general concept is flawed. In that what you really ought to do is just to convert all of the debt in order. Now, let me just go back to the deposit insurance point for a moment. Part of the reason that deposit insurance is it's not enough just to say I'm not going to do it, is no politician wants to be Fernando de la Rua, the president of Argentina, being taken off the roof of the presidential palace in 2001 in a helicopter with a mob of baying depositors outside who were attacking the presidential palace. Nobody wants to be that. And it's all very well for people in think tanks to say, oh, politicians should be braver, but it's not going to be our head on a spike if push comes to shove and the people revolt. So what needs to happen is that you need to have a system in which the voters will hate the politicians more if they do bail out banks than if they don't. How can we achieve that? The way we can achieve that is by making everybody know that if you put your money in a fractional reserve deposit in one of these banks, you have taken a risk that you knew you were taking. So you can't claim I'm just an old granny and I didn't know anything about these things. What needs to be the case is that you have, by putting your money in a fractional reserve deposit, turned down something else. And the something else you should be turning down is a 100% backed deposit in the same institution. So the way it should work is if I go into any fractional reserve bank, which is licensed to accept deposits, I should have to be offered by default a legally ring-fenced account with a storage deposit, a 100% backed deposit. These kinds of deposits used to exist until the 1970s. There were things called savings banks. In fact, in the 1920s and 30s, they were about 1/5 of the total deposit base in the UK, because there's something of that order of money which people simply want to store. A fractional reserve deposit is fundamentally a loan to a bank. A storage deposit ultimately is, and the legal status is probably still that of a loan, but in practice what happens is that you would have perfectly matching assets with zero risk. Now that we have inflation, properly inflation hedged government securities, they won't have the same problem that they had in the 1970s of being wiped out by inflation. Also, they were wiped out by deposit insurance. We didn't have deposit insurance in the UK till 1979. Came in under an EU directive. Perhaps that could be a Brexit dividend, ditching deposit insurance. So the thing about this framework is that then anybody who has put their money in a fractional reserve bank deposit, everybody would know, because they'd have had to do it themselves, would know that you turn down a lower yielding deposit in order to take the risk of the higher yielding fractional reserve deposit. And I believe that that would give the politicians the political wriggle room to say, all these people who put their money, these depositors have put their money in these banks, they did so knowing they were taking a risk, so I'm not going to bail them out. And if you don't have bailouts, there's clear academic evidence that the higher deposit insurance is, the more governments tend to bail things out, the higher financial volatility is, as Jamie was saying before. So you remove the cancer of deposit insurance from the system, you will both increase the ethical basis of the system and you will reduce financial volatility. So I think those are two prices worth having.
So Andrew, in practice, would that mean individuals having kind of a claim on the central bank? Because I know that's an idea that's been floated around. I think Martin Wolf talked about it in the FT as one of his 4 options in response, that we effectively, as he says, banking stands revealed as part of the state masquerading as part of the private sector. And therefore we just effectively say everyone holds a deposit with the central bank if that's the way they want to hold their money, as one option, or the other option is they hold it in a savings account that has higher interest, higher return, but doesn't have that guarantee in the same way.
Well, the exact form that you're going to, whether you're depositing with the central bank or, you know, whether it's some equivalent of national savings, you're lending direct to the government. The point is that it's that it would be a savings bank. What used to happen is that in the period in which you were linked to gold, then what you had was you could hold government securities or gold, because at the time, because that was linked to the currency, that was a perfectly safe way of doing things, and they had matching maturities. So there was no possibility of the savings bank losing your any money that you'd lent to it, other than via fraud or some mismanagement of some sort. So you wouldn't have the normal financial volatility, and that's the point of it. A savings bank isn't a particularly. I don't think you should think of that as a radical new idea. What we're doing, these things existed perfectly happily from 1817 until the 1970s. They were only wiped out when we had high inflation and when we had because they provide fixed safe nominal returns, because there weren't inflation hedged bonds to use at the time, and because there was deposit insurance and bailouts, the bailout of NatWest in 1972. So once you started to bail out fractional reserve deposits, what would be the point of having any money in a safe bank? If you want safe banking, you have to allow banks that aren't safe to go bust, right? I mean, it's pretty straightforward. If you make all the unsafe banks always never lose any money for depositors, then depositors are going to put their money in the unsafe banks because that's going to yield them a higher return. The system needs to allow the existence of perfectly safe banks. Now, so the Federal Reserve actually turned down, there was a thing called the narrow bank, which is in the US, which is an attempt to set up an individual bank, which was 100% backed. The Federal Reserve hasn't allowed it to have access to the payment system. Because what people say is that they worry. Now, this isn't my proposal to have a individual separate institutions. I think that would be a mistake, because I think that you need to have every bank has to have a legally ring-fenced one. So I don't think it's that you want a separate institution. What people worry about, and that were worried about in 2010, was that you would get a kind of type 2 bank run, where people take when the bank starts to get a little bit distressed, people move their money within the bank between their storage deposit account, between their fractional reserve deposit account into their storage account. And that very rapidly undermines the position of the bank, creates a very rapid bank run. Good. Bank runs are good, right? People need to understand that it's not the job of the system to eliminate bank runs. A key thing about bank runs is that they force the bank to be very highly transparent in its very high solvency all of the time. If you eliminate, because otherwise the people with the depositors will remove their money. It's fundamental to the point of a bank, and it's an efficient process of bank run in terms of disciplining the bank. If you think that, if the authorities think that their job, as well as thinking that their job is to make sure that no depositor ever loses any money, which is ethically unsound, they've also somehow got into their heads the idea that it's their job to make sure that there's never any bank runs. That's just a terrible idea, which undermines the whole point of a bank. Bank should have bank runs if the bank is not maintaining a sufficiently high and a highly transparent level of solvency. People run on banks because they worry that they're going to lose access to their money. There's just one last thing I'll say.
Hold on, Julian, and you might come back to you. We've got a few questions that have come in. This might be one for you, Julian. The collapse of two other US banks, Silvergate and Signature, pertain to related collapses in crypto exchanges, FTX, and crypto payment system, Singet. Are the two crises linked or coincidental timing?
Well, I think it's all part of the same story. There are two particular aspects. One is that these are banks that are heavily concentrated in a particular sector. So whether that's the tech sector more generally or crypto specific. So one over concentration of clients in one particular sector. But second, that's a relatively risky sector, and therefore particularly exposed to higher interest rates. So, tech companies tend to be those with the highest valuations on the stock market. So when interest rates go up, they tend to fall the most. We've seen that, Bitcoin is actually a relatively risky asset, rather than being a safe haven in times of trouble. Cryptocurrencies like Bitcoin saw spectacularly big falls when people started to lose confidence in the wider economy, and the Fed started to raise interest rates. So I think it's all part of the same story. I don't think it is a coincidence that they all happen to be in the same sector. These were sectors where there was too much concentration and also too much vulnerability to higher interest rates.
It's also presumably linked in that once you have higher yields on, because interest rates go up on other things, you're not going to get this yield chasing through things like Bitcoin in the same way. So it seems to me that it's absolutely straightforwardly linked.
This might be one for you, Jamie. The question is, were the Swiss wrong to prioritize shareholders over bondholders in their state-backed enforced merger model for terminating Credit Suisse?
Sorry, could you repeat it? Were they wrong to back shareholders?
Shareholders over bondholders. I think this is the case where the living will of Credit Suisse was reversed. That put the the shareholders. I think Andrew referred to this as well.
Yes, the AT1. This is the AT1 issue.
Yeah, I don't really want to get into they're wrong to reverse any. So there are two complicated things here. One is, do you want regulators to be setting the rules and the terms rather than market processes? And I'm with Andrew on this. The other one is, if you have had the state getting involved and they've specified a whole lot of rules, you don't want them changing those rules when the shit hits the fan, because that just introduces more uncertainty into the system. And what it basically encourages is for people to lobby the authorities to do them favors. And of course, this is one of the reasons the whole framework we've got at the moment doesn't really work, because regulators, there's a kind of myth here that regulators there's some kind of special people who somehow can achieve what people with skin in the game can't achieve. And that's a crazy idea. You see regulatory failure all over the place. And it's not just that it's regulatory failure, it's regulatory capture as well. Who are these people, right? They're often ex-bankers, they're often friends with bankers. Sometimes they're funded in ways that give them interest in growing the banking sector in their region. In America, I think they're funded in that way. There's a kind of regional framework. There are all sorts of perverse things that are going to happen within this framework. So, I almost always think what regulators do is wrong, but I particularly think it's wrong when they change their own rules, right? You've got to stick, if you've specified some rules, these are the terms under which the banking system's operating. You can't, if you change it at the last minute, then your rulemaking subsequently is worthless, right? I mean, of course, that's already the situation. Nobody really believes that bank creditors aren't going to be bailed out because they're uninsured. Who would believe that? You'd have to be very politically naive to believe that just because that's what's said, that's what's going to happen. Everybody knows, as Andrew pointed out, that that's not going to happen. The creditors are going to get bailed out. All sorts of people. So
Julian,
you set me off, I'm afraid.
Yeah, I mean, specifically on what's happened to the bondholders of Credit Suisse, or to be precise, the holders of a particular type of bond in Credit Suisse. I know this is controversial because as it stands, they're going to lose all of their money, whereas shareholders will at least get some very, very small proportion of their money back in the form of shares in UBS. So I can understand why this is controversial, and I understand why the regulators in the UK and in the European Union have come out and said this wouldn't happen if it were a British or EU bank that went under. I also think it's very important to protect property rights. I think there are two concepts here. There's moral hazard, but also property rights. And I don't think anybody should have money taken away from them in ways that are basically breaching the terms of a contract that they have. However, in the specific case of Credit Suisse, and as I understand it, also UBS, if UBS were to go under, these particular type of bonds did have a clause in the contract that basically said if the bank has to be bailed out by the state, then at that point, these bonds are written down to zero. So I think what the Swiss did was not actually breaking the rules or setting a precedent. They were simply following the terms of the contract that bondholders had signed up to. So in these circumstances, I don't actually have a lot of sympathy for the holders of these bonds, who by and large, of course, by definition, were supposed to be relatively savvy, sophisticated investors who, I don't think deserve any special treatment in these circumstances. So I actually don't have a problem with what's happened to those bondholders, but equally I can understand why they're going to be litigious about it, because there are billions of dollars at stake here.
Andrew?
Yes, well, one thing I think to say is that the exact status of the triggers for the write-down is a matter of dispute, and I think there's probably going to be some big legal cases, including some people who probably buy the bonds, like vulture funds who buy the bonds and try to pursue them in order, even though they've been written down, and who knows, maybe they'll get something out of that. Another thing I think to say is that the way that the rules worked was that the Swiss central bank, in its framework, explicitly had very high level of discretion on the treatment, higher than that of other central banks. So it was pretty explicit that it had a very high level of discretion to do this. Obviously, even in the case of violating the contracts potentially. My view on this is that if you were going to have that, you should treat all debt as bail-inable. There shouldn't be a special class of bail-inable debt, because if you say I've got a special class of bail-inable debt, that rather suggests that the other debt isn't bail-inable. And actually what should happen is that if your bank starts to get distressed, the authorities should be able to step in and say, well, you're converting all of these. Because what would happen in an efficient market environment in which you didn't have the risk of government inefficiently bailing out banks in order to spare depositors would be that the creditors themselves would come to an agreement with the institution over the process of being converted. That's what, if you lend money to a chip shop and the chip shop doesn't pay you back, then you own a chip shop. You suddenly have some shares in a chip shop. That's the way. If I lend money to a bank and the bank doesn't pay me back, then I own a bank. That's the way that it would work. The reason why that doesn't work properly is because the creditors themselves play a game of chicken with the authorities that the authorities will bail the institution out. So it tends to wait too long. It's inefficiently long before they accept being converted. The solution to that problem is for the authorities to bail them in themselves. So they force the bail-in of these things, and that should happen by the priority, the debt priority. The only purpose of having a special category of debt, which I think is dangerous in itself because it suggests that the other creditors won't be bailed in, is if you are going to convert it when you don't wipe out all the equity. So you could imagine that you had a special category of debt where it gets converted at the point at which my equity falls, my other capital buffers fall below certain triggers, regulatory triggers, so that then you have some kind of intervention. So it automatically gets converted at the point of intervention, which is what happened in the case of the Swiss. So if you were going to have this special category of contingent convertible debt, which I'm not sure is a good idea, but if you are going to have it, then the way the Swiss have done it is the right way to do it.
I just want to move on to some kind of more immediate potential implications, which is we're expecting the latest news on interest rates from the Bank of England, I believe at midday today. Is the current thinking, and it seems like the markets have come to this conclusion that, well, as a result of all this financial instability, the central bankers are going to slow down interest rate increases. Is that analysis correct? And what are the implications of that? Are we going to then see higher levels of inflation sustained over time because of concerns about the financial sector, and therefore potentially actually a longer term kind of slowing down of the economic recovery? I don't know, Julian, do you want to take that one?
Yeah, well, I'll start on that. I mean, the first point to emphasize when looking at interest rates is that, central banks basically have two responsibilities. One is monetary stability, which basically means hitting an inflation target of 2%. And the other is financial stability, which is about protecting the financial system, making sure that our money is safe, and so on and so on. The decision today is supposed to be about monetary stability. In other words, getting inflation back down to target. So at face value, what's happening in the banking system, shouldn't really matter. The two things are not completely separate, because if you did have a banking crash and a repeat of the global financial crisis, then the economy would collapse, and that could mean that inflation ends up lower than otherwise. But if you don't believe that's going to happen, then I think the bank should just do whatever it would have done anyway on interest rates based on what it thinks is the outlook for inflation. Now, as it happens, I think that would justify not raising rates today. But it may well be that the numbers earlier in the week have spooked them, and they'll go ahead with a 1/4 point increase. In terms of financial stability, there's a separate set of tools, if you like, that the central banks have to deal with those. Additional liquidity support for banks that are in good shape. But I certainly don't think that they should be rapidly rethinking economic policy, monetary policy completely on the back of the banking crisis. There's one caveat to that, though, which is that the banking crisis is another of these examples of how the increase in interest rates last year, the full effects of that only just starting to be felt. So you could look at the banking crisis or the slowdown in the housing market or the problems in the pension fund industry, and that might be a reason to pause, simply because it shows that what you've already been doing, the full effects of that are only starting to come through. So that's the way I would look at it if I was sitting on the Monetary Policy Committee. Not that I'm worried about a banking crisis per se. Actually, I think it's quite good that bad banks should be failing, and that's markets working. I think it's more that might be a sort of symptom of bigger problems as a result of the monetary tightening that's already taken place.
We've got a comment/question from Alex Moore, who says, thanks for the great event. It feels like a major problem is political, where bankers from investment banks weaken ring fencing so they benefit from accessing quote unquote safe deposits in full knowledge that if they fail that they'll be bailed out. Unlike our thoughtful economists, many free market journals often parrot the kind of lobbyist idea from the banking sector that what really needs to happen is you need to remove overregulation, free up capital, when what they actually mean in practice from the banks, I suppose, is saying is that they will allow access to guaranteed deposits for investment/casino banking. What's the best way to kind of stop that confusion, where what the banks that are lobbyists are effectively demanding is a regulatory situation where if they win, they and take risks, they get the benefits, but if they lose, the taxpayers pay the costs.
Well, I mean, that's what in particular Andrew and I have been talking about. That's the system we have, right? This is, at the time of the financial crisis, I found myself unusually in agreement with several left-wing politicians that I normally was not. They were saying, it's a privatized profits and socialized losses, which is really, it's economically bad. It's also, as Andrew pointed out, morally outrageous. And I think it's one of the big structural problems that we face today. And the banking sector's had terrible kind of secondary effects in the way capital gets allocated because of this stuff. So it's a big problem. And I mean, the answer that, I mean, I haven't got many practical suggestions, I'm afraid. I mean, Andrew's is very interesting. It's the problem, as always, isn't knowing what the right economic policy is. It's how politically could it ever get done? So there are all sorts of things that I think are the right way of doing things, but I realized that they're just never going to happen as a matter of policy. And that is the question. So I think Andrew's is a really interesting suggestion for how to solve that problem. And I think what isn't the answer is what will probably be done, which is re-regulation. Because you'll just get these people queuing up for regulatory favors yet again. And also, one other thing I didn't say earlier is that risk-taking in banking is extremely opaque. It's very, very difficult for anybody, let alone regulators, to really understand what's going on. Now, if banks paid a price for that opacity in the market, they would have an interest in being transparent. And so if you regulate them heavily but don't and protect them from pricing, they lose any interest in transparency beyond what the regulator demands. And so that requires the regulators to know what to be looking for, and they don't often. And so I just fear that we're just going to double down on the same broken approach that we have. And so we need some new thinking like Andrew's.
Andrew,
I'm afraid I haven't got
one
it.
So a couple of things. So first of all, I think that this idea that the problem is somehow investment banking, casino banks combining themselves with other kinds of safe activities, that's all confused. It's as confused as the idea that what we really need to do is get back to the building societies. If you think about these, I mean, retail banking, it isn't that retail banking is safe and that these things are dragged down by investment banking. HBOS, for example, in 20, it's perfect, almost entirely retail banking was dragged down by almost entirely retail sector activities. We were just hearing that Silicon Valley Bank wasn't dragged down by anything fancy. It just put its money in government bonds. It hadn't engaged in some kind of high finance derivatives kind of a thing. The fundamental issue with a fractional reserve bank is that all fractional reserve banking activities are risk-taking. It's in the nature of fractional reserve banking. You lend your money to the bank, that's what a fractional reserve deposit is. You're not just storing it there, you're lending your money to the bank then takes some risks with the money, they turn out well or not, and it pays you some interest in order to use your money whilst it's doing that. And it needs to do more risky things if it wants to pay you higher interest. It's a mistake. And the idea that the solution is somehow to separate out these activities. In the US, that didn't work at all. When they separated out the commercial and the investment banking from the 30s onwards, all that Glass-Steagall stuff, all it did was mean that you had an excessive level of corporate bond activity in US financing relative to bank lending. It's much more dominant in Europe. The UK is probably the best blend because we have more equity than they do in Europe. One other thing to say here, so I think that's a mistake. The correct thing, the only safe thing, is 100% backed bank. Fractional reserve banks that engage in lending for the housing market or lending to retail activities are not safe. They're not even safer than investment banking because they're probably less able to diversify their activities, and so they're more exposed to the economic cycle. So when you get a downturn, then they get more stuff than an investment bank. Investment banks have more idiosyncratic risk, but probably less systematic risk, and so less able to diversify. One other thing that I wanted to say here is that I'm very much endorse Jamie's point about the regulators. The process of regulating a large bank, Credit Suisse, say, I mean, Credit Suisse, one of the 9 bulge bracket investment banks, the process is the idea that a regulator could look into and identify some efficient way of deciding for all of Credit Suisse's diverse activities, all the individual lending, the massive scale of lending that it does, what it regulated in an efficient way, is a process approximately equivalent to that of planning an entire economy. If it were the case that regulators could regulate banks so that their activities were efficient, then I think communism would be it's literally the same kind of claim as claiming that communists can efficiently centrally plan an economy. And I think that for exactly the same reason that communism is a bad system, it's completely hopeless to imagine that a regulator can regulate a bank in detail and make it efficient. That can never work.
So we're just running to time, but I think there were some good comments in here from Tom Bergerus, who points out that the Swiss banks were generally held to higher capital standards, but they suffered from issues like scandals and other losses. And also the point, the Northern Trust was largely, Northern Rock was largely a retail bank. It wasn't doing kind of fancy things. It was just a kind of classic bank failure.
I think that's a really, really good point. At the end of the day, these were crap banks, and they should be allowed to fail in some way. I mean, certainly anybody who invested their money should pay a very significant price for that, as well as the people who are running the business.
Can I tell you a wonderful anecdote about this? So I used to be, well, I still am friendly with the former Reserve Bank governor of New Zealand, Don Brash, and he told me a story that when he was governor of the Reserve Bank, he was at some dinner, and a chap who had just got a job on the board of a British bank was chatting to him at dinner. He said, well, I was a bit worried when I got this job, he said to Don, because, banking's really all about risk. And I don't know anything about risk. And he said, but it's okay because I've discovered that the regulators look after that. That's the attitude. You can be a crap bank. It doesn't matter, right? Because the government's got your back.
I would almost say it's a badge of honor if a bank in my country failed, because it shows that we're allowing market forces to work properly, that we're not going to bail out incompetence. It wouldn't worry me too much at all.
You also can't have proper market entry unless you allow the failure of the existing institutions. You're not going to be a very good cuckoo if you can't push the other birds out of the nest. So the process of bailing out banks is highly anti-competitive, and it makes for an inefficient system as well as everything else.
Well, on that note, thank you very much, Julian, Andrew, and Jamie, as well as everyone who's joined and asked excellent questions. It's been a fascinating discussion. I look forward to hosting more media briefings in future.
Well, if you enjoyed that conversation, why not watch one of these other videos? And while you're here, remember to hit the subscribe button and the notification bell. That way, you'll never miss out on a single IEA broadcast.